Coming to the options, options are also contracts. They are sold by the option seller to the option buyer. The option seller is also called as the option writer. The contract offers the buyer, it's important, the buyer the right but not the obligation to buy in case of call option, or a sell in case of put option for the underlying asset at a agreed upon price for a specified duration. The duration can be weekly, monthly, quarterly, etc. So please note that the buyer has the right, but he does not have the obligation. The seller only has the obligation. In case of futures, if you have observed, both buyer and seller has the obligation to satisfy the contract. But whereas in case of options, only the seller has the obligation to satisfy the contract. Don't worry, I will get more deep into what is a call option, what is a put option to make it more clear to you. Coming to the components of the options, we saw the components of the future. So like in future, we have instrument. It could be Nifty, Bank Nifty, or any of the stock. And we also have the lot size, which is same as in case of future. And the expiry date, it could be weekly, monthly, or quarterly, like in futures. So these three components are exactly same as in case of future. But the two important new components that are there in case of options are strike price and the premium. So what is a strike price? It is a price at which option buyer and seller agrees to exchange the asset. So you get to choose the strike at which a buyer and seller agree to exchange the asset. In case of future, there is no strike. Whatever is the price that you have sold or bought is the price. Here, whatever is the strike price that you choose is the price at which the asset will be exchanged. This is very important. Please note. And the premium is paid by the buyer to the seller. That is why the buyer do not have an obligation and seller receives the premium and he is obliged to satisfy the contract in case if the contract goes in the money. So the strike and the premium are the new two components in case of options. We will get more deep into these things. Here is the relationship between the option buyer and the option seller with respect to the option premium. It is always the buyer who pays the premium to the seller. The seller receives the premium and he keeps it with him. This is irrespective of whether the option contract is the call option or the put option contract. Because the seller receives the premium, he is obliged to fulfill the option contracts, whether it is put or call, when it goes in the money on the day of expiry. Don't worry, we will look into what is call option, put option, in the money, etc. few moments from now. The main use of futures and options are for hedging, speculation, arbitrage, and implementing strategies to generate the monthly income. In fact, when the futures and options were introduced way back, the main purpose was to provide a feature to hedge against the assets that people own. What is hedging? Hedging is nothing but taking an insurance against the asset that you own for the price fluctuation in the market. Eventually, they became more popular and people started using it for other reasons. Speculation is that you build a market view and based on the market view, you design the strategies so that you can make money out of it. Arbitrage is nothing but to capture the price difference between the two instruments. For example, the current month future and the next month future may have a slight difference and you may want to capture that slight difference to make money out of the price difference between these two instruments. But arbitrage is not so popular because the moment people know that there is an arbitrage opportunity, people will grab it and it will disappear. Next one is implementing strategies to generate monthly income. This is quite popular. Futures and options can be used to design many strategies based on the view of the market to generate the monthly income. We'll look at all those things during the course. There are two types of traders. One is a hedger. Hedger just want to minimize the loss to his portfolio and hedge the assets. using the futures or options. The other type of trader is speculator. Based on the view of the market, he builds a view, and then for that view, he builds the strategy to make money out of the speculation. Friends, please note that futures and options are not a gambling instruments at all. They are there for the specific purposes that we discussed. If you use them properly, you can generate a money out of it, and also you can hedge your assets if you are owning the assets. And they offer you various kinds of strategies that you can build based on your style, based on the market view, which we will be seeing during this course. So what is a call option? Call option is an option contract which gives the holder, nothing but the buyer, the right but not the obligation to buy an asset by a certain date for a given price. The given price is always the strike price at which the contract is being executed. So if you think from the seller point of view, if the option, the call option goes in the money, the seller is obliged to deliver an asset at that strike price at which the contract, the call contract is being executed to the buyer. In case of call option, seller has to deliver an asset at that strike price by keeping the premium that he has received. It doesn't matter at what price the seller is owning the asset, but he has to deliver at the strike price at which the call contract is being executed. Here is an illustration. For example, there is a contractor who intend to sell a property for 1 crore. Okay. And a buyer, for example, you and me would like to buy a property, a house at this price, but we pay a token advance of, let's say, 5 lakhs and get into an agreement. So that is nothing but a contract. And at the end of the period, for example, 6 months, 1 year, 2 years, once the property is ready, you have an option to buy the property at the specified price of 1 crore, or you have an option to leaving the 5 lakh advance to the builder. So the builder is obliged to deliver a property to the buyer exactly at 1 crore, irrespective of what is the value of the property when he is actually delivering to the buyer. So to do that, he takes the 5 lakhs as the advance, that is the premium from the house buyer. So that is an illustration of the call option in the real world. So what is a put option? It is exactly the opposite side of the call option. A put option is an option contract that gives the holder, nothing but the buyer of a put option, the right but not the obligation to sell an asset by a certain period, certain date for a specific price, which is nothing but the strike price at which the put option is being executed. If you think from the seller point of view, the seller of the put option point of view, when the put option goes in the money, he is obliged to take or receive the delivery of the asset at that particular price, which is the strike price, by the buyer. And of course, here also he keeps the premium that he has received from the buyer. Irrespective of what price the put option buyer is owning the asset, he has to deliver the asset at that put option strike price to the seller. The seller always knows he is going to receive the asset at that particular strike price, keeping the premium. Here is the real-time analogy for the put option. There is a company which sells the insurances to the car buyer, and the buyer pays the premium of 20,000 and gets into a contract with the insurance company saying that in case of any damage or any event to the car, the maximum amount, that is 8 lakhs, let us say, will be borne by the insurance company. So that means the seller of an insurance is obliged to receive the delivery of the car, nothing but paying the cost of the car to the buyer of an insurance by keeping the 20,000 premium that is given by the buyer. So that means when the put option, in the case of any event to the car, put option goes in the money, the seller of a put option need to have that much of money, in this case 8 lakhs, to give it to the buyer. So that is how the put option works. Friends, the easiest way to remember the put and call option is that in case of call option, seller has to deliver an asset at that particular strike price, irrespective of what price he has bought that asset. So that means he need to have an asset to deliver when the call option goes in the money. In case of put option, the seller of a put option need to have that much of cash in case the put option goes in the money to take the delivery of the asset. So that's all you need to remember. This concept is very important when we are doing the covered call and cash secured puts. So that is why please try to understand this, how it works. Here is the matrix of call and put option with respect to buyer and a seller. In case of call option, the buyer has the right to buy. The risk is limited to the premium that he has paid and the reward is unlimited. For the seller point of view, he has the obligation to sell an asset when the call option goes in the money. And the risk is unlimited if it is not hedged. The reward is always limited to the premium that he has received. So for the put option, buyer has the right to sell, and again the risk is limited to the premium that he has paid. The reward is unlimited. The seller, he has obligation to buy the asset at that particular strike price, and the risk is unlimited. The reward is limited to the premium that he has received. There are mainly two categories of options. One is based on the exercise type, other one is based on the underlying assets. Under the category of options based on the underlying, there are two types of options. One is the index options, other one is the stock options. The index options are nothing but the options that are derived from the major indices. For example, in India, Nifty has options, Bank Nifty and Fin Nifty. And all these index options are cash settled. There is no physical settlement. The options that are in the money will be cash settled. And the liquidity for the index options is normally quite high compared to the stock options. The stock options are nothing but the options that are derived from the underlying stocks such as State Bank of India, Reliance, etc. And note that all these stock options will be physically settled if you have opted for physical settlement. That means based on the type of options that you hold, you will have to receive or deliver one lot of the stock quantities to the exchange. And again, the liquidity is dependent on the stock. Some stocks have good liquidity and some stocks do not have the enough liquidity. Under the category of options based on the exercise, there are two types of options. One is the American options, other one is the European options. American options are nothing but the options that can be exercised anytime before the date of expiry. So the trader will have an option to exercise these options anytime before the date of expiry. In case of European options, these options can be exercised only on the day of expiry. So the traders can buy and sell options till the time the options get expired without having to worry about options getting assigned. So all the options in India are the European options, whereas in the US equity market, all the options are American options. In the Indian equity market, there is no risk of early assignment of options. You can always wait till the last day of expiry to decide to take the delivery or receive the delivery, or you can even square off avoiding the physical settlement. Whereas in case of American equity market, options are American options, there is always a risk of early assignment. So you may easily get assigned for the physical settlement. You will have to do the physical settlement. Friends, I would like to introduce some of the general terminologies that are used in the trading world, because many people ask this question during my workshops. One is the P&L. P&L is nothing but the profit and loss. So the profit and loss can be a realized profit and loss, or it can be a unrealized profit and loss. The profit or the loss that is shown in your trading system during the life of the trade, that means before closing the trade, is nothing but the unrealized profit and loss. The moment you close that particular trade, it can be a profit or a loss that will be a realized profit and loss. Coming to MTM, M2M is nothing but mark to market. It is an unrealized profit and loss before closing the position. So we keep saying MTM swing is high, MTM swing is low, etc. So that is nothing but the unrealized profit and loss that is shown under a particular trade in your trading system. The moment you close, it becomes a realized P&L for that particular trade. Coming to BEP. BEP is nothing but the break-even point. It is the price at which a particular trade will become no profit, no loss. That is nothing but the break-even point. I would like to now introduce some of the terminologies specific to the options. First one is the strike price. Strike price is nothing but the price at which the exercise happens. For example, if we have bought a particular option, let's say, for example, State Bank of India 500, you have bought or sold an option, that is the price at which the exercise happens if you opt for the physical settlement. So if you see in the option chain, there are various strike prices that you have a choice to choose. Anyway, I will be explaining the option chain. And the strike price is also called as the exercise price or a strike. It is interchangeably used. Coming to the spot price is nothing but the current price of the underlying. It can be an index or it can be a stock. Whatever is the underlying, the current price is called as the spot price. It is also called as, in general, a spot. Next one is the spread. The spread is nothing but the distance between two strikes. For example, if you take Nifty 17,500 and 17,700 strikes, what is the distance or the difference between these two strikes? It is 200. Next one is there is something called spread premium. For example, 17,500 CE is, let us assume, trading at 100 rupees and 17,700 CE is trading at 25 rupees. What is the difference in the premium between these two strikes? 100 minus 25, which is equal to 75. So the spread is 200 and the spread premium is 75. So these terminologies are important when we discuss the option strategies to calculate break-even point, P&L, etc. We will now discuss the very important aspect of the options, that is moneyness. Moneyness is nothing but how much is the value that the option has at the current moment. There are three types of moneyness, that is ITM, in the money, ATM, at the money, OTM, out of the money. And again, we have two types of options that we discussed. One is call option and the put option. So we need to identify the moneyness for each of these option types separately. We will now discuss the very important aspect of the options, that is moneyness. Moneyness is nothing but how much is the value that the option has at the current moment. There are three types of moneyness, that is ITM, in the money, ATM, at the money, OTM, out of the money. And again, we have two types of options that we discussed. One is call option and the put option. So we need to identify the moneyness for each of these option types separately. All the in the money options do have a value and they need to be exercised and settled. And at the money options also do have a value based on the premium. They also need to be settled. And all the out of the money options, whether it is a call option or put option, they do not possess any value and they expire worthless. In case of the ITM, when the seller or buyer has decided to close the option when it is in the money, based on the premium received by the seller and by how much it is in the money may have to be paid back to the buyer. Similarly, at the money options also, if it slightly becomes in the money based on the premium, the settlement has to be done. For OTM options, the entire premium will be kept by the option seller, no settlement or no payback to the buyer. As they expire worthless, the entire money is kept by the option seller, be it a call option or put option. Don't worry, I will be taking an example and explaining to you how to calculate the break-even points and how much money has to be settled between buyer and the seller. So now let us look at one by one. For the ITM, that is in the money, all the call strikes below the spot are in the money options, and all the put strikes above the spot are in the money put options, and all call and put strikes at or closer to the spot, that's the current market price, are at the money strikes, and all the call strikes above the spot are out of the money, and all the put strikes below the spot are out of the money. So the easiest way to remember is, for example, this is how I do. Let us assume Nifty is trading at 17,500. So 17,500 call and put option are at the money. That's where the spot is, that's where Nifty is trading. So we can call them as at the money strikes. And all the call options above the 17,500, for example, 17,600, 700, etc. are OTM. All call options above the spot are OTM. And opposite to this is the ITM for call option. And all the put strikes below the 17,500 are OTM. All the puts. So this is how I remember, and the opposite is the ITM for the put option. So here is the option chain. I'm going to explain how to interpret the option chain. This is the Nifty option chain that I have taken from the NSE website. These option chains can be obtained directly from the NSE website, or your broker application might have provided the option chain. So if you see here, in the middle, you have the strikes. Nifty is right now trading at 17,950. The spot is at 17,950. And if you go downwards, the strike price is increasing. You see here 18,000, 18,050, 18,100, etc. The step size for Nifty is 50. And if you go upwards, the strike price is decreasing. This is the standard way of representing the option chain, and this is how all the applications or tools are displaying the option chain. Left side you have the call options, right side you have the put options. For each of the options, you have different parameters being displayed on each of the columns. For example, you have open interest for the call option, change in open interest, volume, implied volatility, last traded price, change in the price, bid quantity, bid, ask quantity, etc. Similarly, we have those parameters for the put options as well. Now, how do you identify which options are out of the money, at the money, or in the money? You see here, at the money is where the spot is. 17,950 strike is at the money strike. You can see here, at the money strike. And you can see the price here. The last traded price is 96. The last traded 96 for call option, and the last traded price for put option is 90. And all the call options above the spot, this side, the white area, are out of the money call options. And opposite side, that is all the call options below the spot. Here, the shaded area, all these call options are in the money call options. Similarly, for the put options, all the put options which are below the spot, are out of the money, this white area. And the opposite side is the in the money for the put options. This is how you have to interpret. Let us now look at the components of the option premium or the option price. We know now that the option premium is being paid by the option buyer to the seller. The major two components of the option premium are intrinsic value and the extrinsic value, which is also called as the time value. Intrinsic value is nothing but the amount by which the option is in the money is what is intrinsic value. And the time value is nothing but the premium minus the intrinsic value is the time value of the option premium. So we have intrinsic value which is decided by the spot and the strike price by how much they are in the money, the distance. So that is what is the underlying spot and the strike price decides the intrinsic value of the option premium. That is a straightforward calculation. For the extrinsic value, it depends on the three components again, that is the time remaining. So if you have a longer time to expire, then you will have more premium. That means, for example, weekly options have lesser premium compared to the monthly options because monthly options has a longer time to expire. Next one is the volatility. If the market is highly volatile, then the premiums are higher. If the volatility is less, the premiums are lesser. Next component is the rate of interest. If the rate of interest to borrow the money is higher and the premium will be also higher. So that is how the intrinsic value is decided. That is the time value is decided. Let us take a couple of examples to calculate the intrinsic value and the time value of the options. In the first example, I am taking the call option for Nifty, which is trading at 10,800. Let us say there is a call option that is executed at the strike price of 10,700 at the premium of 350 rupees. Now, the 10,700 call option is in the money because the spot is at 10,800. The call option is below the spot, so that means it is in the money. By how much? That is the distance between the spot and the strike price. That is 100 points. Nothing but 100 rupees. That is nothing but the in the money value, which is intrinsic value of this call option. And to calculate the time value, you have to remove the intrinsic value from the premium. So that is 350 minus the intrinsic value, which is 100, is equal to 250 is the time value of this option at this moment. That is when the spot is at 10,800 for this call option. Let us now take the put option as an example. Again, the Nifty is currently trading at 10,800. That is the spot. Assume that there is a put option contract at the strike price 10,900 executed at the premium of 175 rupees. First of all, the 10,900 put option is in the money. That is because this strike is above the spot. 10,900 strike is above the spot for the put option. So how much it is in the money? The distance between the strike and the spot again. So that is 100 points, 100 rupees. That is nothing but the in the money value or the intrinsic value. Now again, to calculate the time value, you have to take the premium, which is 175, and remove the intrinsic value, which is 100. 175 minus 100 is the 75 rupees is the time value for this put option at this point in time when the Nifty is at 10,800. That is how we have to calculate the in the money and the in the money value and the time value for call and put options. Again, I would like to reiterate that all the OTM strikes or the OTM premiums only has the time value and they do not have any intrinsic value. They expire worthless. Let us now calculate the profit and loss for both buyer and seller point of view for call option and put option when they get expired. In the first example, I am taking call option. Let us assume that Nifty gets expired in this case at 10,900. But the contract was executed at 10,700 strike price for the call option at the premium of 375 before the expiry. First of all, this is in the money because the spot is above the strike price for this call option. So how much it is in the money? That is the distance between the spot and the strike price. That is 200 points. You see here the settlement price or the ITM value of this strike price when Nifty gets expired at 10,900. is 200 points. Now to calculate the profit and loss for the seller point of view, seller has to give back how much? The value that is in the money. So now the value is 200 points. So he has to give back 200 points from the premium that he has received. So that means the profit and loss for the seller is the premium received minus the settlement price, the ITM value. 375 minus 200 is 175 rupees. It is still a positive value. So that means the seller still keeps the 175 points in this case. Now from the buyer point of view, what will happen? He will still lose because he has paid 375 as a premium to the seller, but he is only receiving 200 points. So that means he is not getting more than what he has paid. So he still loses 375 minus 200, which is 175 points. So that is how the settlement happens. So to calculate the break-even point for the seller is simply you have to add the premium received to the strike price. The strike price is 10,700 plus 375, which comes out to be 11,075 in this case. So this is the break-even point for the seller for the call option of 10,700. When Nifty expires above 11,075, then the seller will start paying more than what he has received. That is when he will start losing the money. So this is how we have to calculate the break-even point for the call option. Now in the second example, I'm taking the put. Let us assume that the Nifty gets expired at 10,800, but there was a contract that was executed at the strike price of 10,900 put option. The premium that was received by seller was 250 rupees. Now the settlement price, how much is the in the money? The distance between the spot and the strike, which is 100 points. So to calculate again the P&L for the seller point of view, the premium minus the settlement, the ITM price, which is 100 here. So 250 minus 100 becomes 150. So the seller still keeps 150 rupees, 150 points as a profit, as he has received more premium than the ITM value. So the buyer again will lose how much? 250 he has paid as a premium and he is receiving only 100. So he will still lose 150 points. So again, for calculating the break-even point for the seller is you have to take the strike price, which is 10,900 here, and subtract the points that are received as a premium by the buyer. So which comes out in this case is 10,650. So the break-even point for the seller is 10,650 in this case for the strike price of 10,900 put option. So that is how we have to calculate the break-even point for the put option. So friends, as I mentioned, all the OTM options gets expired worthless. The seller will keep all the premium that he has received, and there is a statistics that 80 to 90% of the options expire worthless. So that is the statistics all over the world, which is important to note. Friends, you don't have to sit and do all the calculations for all these options. If you are using the option trading tools, they will automatically calculate and let you know the break-even point, the premium received, etc. But it is important to practice to get an idea of quickly the premiums and a rough idea of the break-even points to even start thinking about the strategies. Let us now look at the option expiry day and the different option expiry series. The option expiry day is the day on which all the options associated in that series will get expired. By the end of the trading day, all those options will get expired. There are different option expiry series. One is the weekly expiry series, other one is the monthly expiry series. In the weekly expiry series, we have Bank Nifty, Nifty and Fin Nifty. In the monthly expiry series, we also have all the index series, Bank Nifty, Nifty and Fin Nifty, and also there are stock options that are available which are traded in the F&O segment. So Bank Nifty and Nifty, they do get expired on every Thursday. Every Thursday, Bank Nifty and Nifty will get expired for the weekly series. And for monthly series, the last Thursday of the month, they will get expired. And for stock options also, the last Thursday of the month, there is a expiry day. For FinNifty, the weekly expiry is on every Tuesday. And for monthly expiry, the last Tuesday of the month is the expiry for the FinNifty. If there is a holiday on that particular weekly expiry, it could be on Thursday or Tuesday, the expiry day will be preponed by a previous working day. For example, if Thursday is expiry for Nifty, Bank Nifty, if it is a holiday, then it will be preponed to Wednesday. If Tuesday is a holiday for FinNifty, then it will be postponed to previous working day, which is Monday for FinNifty expiry. Here is the option chain from the NSE website. This is the Nifty option chain. If you see here the expiry day, you can find every week there is a expiry. If you see in the month of March 2nd, 9th, 16th, 13th. So similarly, we have it for Bank Nifty also. And if you look at FinNifty, there are expiry days for every week. And if I go to any of the symbol, for example, SBI, SBIN, now if you see, there are monthly series only. There are no weekly series of February 23rd, 29th of March, 27th of April. So those are the monthly expiries for the stocks. Who does the exercise process and when they will be doing the exercise process? It is the exchange that does the exercise process at the end of expiry day and settle all the cash or the shares to the contract holders. As I mentioned, all stocks are physically settled. If you have opted for the physical settlement, the number of shares will be delivered to your trading account or taken out from your trading account based on the settlement process. And one can trade, you can buy or sell the options till the end of expiry day, till the exchange closes. Right now it is 3:30 p.m. As I mentioned, all the in the money call and put options only will get exercised. The out of the money call and put options will not be exercised because they are worthless and there is no moneyness in the OTM call and put options. Now coming to who does the futures exercising and when the futures will be exercised. First of all, it is important to know that there are no weekly futures expiry available in Indian equity market. The futures are available only in the monthly series for the Indian equity market. Be it a index future or stock future, they are only available for monthly expiry. And that too, all the future contracts are available for the current month plus 2 months only. So that means any given point in time, you will have a current month future contract and the next 2 month future contracts for indices as well as for the stocks. So in case of futures also, of course, exchange does the exercise process at the end of the expiry day and settles the cash or the shares to the contract holders. So one can buy or sell futures till the end of expiry day till the exchange trading time, which is 3:30 p.m. And if you have opted for the stock futures for the physical settlement, these stocks will be delivered or taken out from your trading account. So that is how the futures exercising takes place. Friends, just a note that from time to time, NSE exchange does introduce various instruments. For example, there were no weekly expiries for Nifty and Bank Nifty. They got introduced and FinNifty was not there. It was recently introduced. So like that, I'm not surprised in future, the weekly futures may also get introduced. I'm just explaining the current situation as of now. Let us now discuss why option selling is better than option buying. So what does any trader need to make money? He needs mainly two things. One is an edge and other one is the hedge. When you have these two, the probability of making a money is quite high. So in case of option selling, what are the edge and hedge? The natural edge that you get is the time decay. The moment you sell any of the options, the time decay will start. But in case of option buying, that will act against you. The time decay will be an enemy of the option buyer, and time decay is the friend of the option seller. What is a hedge in case of the option selling? You can have a number of strategies that you can design, and there are multiple ways to hedge any of the positions in case of option selling. But that is not so easy in case of option buying. The statistics do confirm that 80% of the options expire worthless at the end of the each expiry. So that means this is the right place to be in to make money out of this. And we also know that most institutional traders do option selling, and in option selling, the maximum profit and the max loss that you can incur can be known. The maximum profit is nothing but the premium or the credit that you have received. The maximum loss is up to you how you want to design the strategy, but it is possible to define in case of option selling. In case of option buying, the maximum profit, we can say unlimited, but what is the probability? It all depends on how good is your setup and how fast you are to take a action. So to make money out of option buying, you definitely need a sophisticated setup and a quick action to make money. So that is why it is difficult to make, or it is more difficult to make money in option buying than in option selling. I'm not saying option buyers will not make money, but definitely you need a lot of sophisticated system and quick action to make money out of option buying. Option selling is quite flexible. You can define plenty of strategies that suits you to make money out of option selling. There are a number of myths about option selling. Let us decode them one by one. The first one is the option selling has unlimited risk. Yes, it has an unlimited risk if you do the naked option selling without a hedge. There is always a possibility to hedge your position or create a strategy to define the maximum risk that you are ready to take, which is not possible in option buying. The next one is return is less. I don't think the return is less. If you properly utilize your money and do the proper money management, you can generate more returns in option selling. In fact, you can pledge your assets, that is, take a collateral, get a margin, and you can only trade out of your margin to make a money out of it. You may have an investment in your stocks or any other mutual funds, etc. You can pledge them, get a collateral, a margin money, and simply using that margin money, you will be able to trade in option selling and generate a money out of that. Option selling has the limited profit. Yes, it has a limited profit, which is equal to the premium or the credit that you have received. But one can do a reference trading, which is nothing but rolling up or down your positions to make more money out of your positions. It is always better to make a small money with a proper hedging, proper strategies, more number of times than taking a big risk and aiming for the unlimited profit. Next one is the option selling needs a special software to understand the option Greeks, etc. Friends, absolutely you don't need any special software to know more about the option Greeks. In fact, the option Greeks are available and provided by your broker software itself, but I don't think you need any of those special softwares with Greeks to make money out of option selling. Of course, you may need an option trading software which provides you a facility to create strategies with payoff graphs, etc. That will help you, but you may not need a very special software which gives you details of option Greeks. Need huge capital to start the option selling. You may not need a very huge capital to start the option selling. You do need around 5 to 10 lakh capital, and half of it can come from any of your investments such as stocks, mutual funds, or bonds, etc. You can use them as a collateral and start trading. So all in all, option option selling is much better compared to the option buying. Once again, option buying definitely needs a proper sophisticated setup to make money. And for me, it is almost like a lottery. But whereas option selling offers you plenty of options to make money, if you use those strategies properly with a proper market view, one can definitely make money out of option selling. Let us now look at futures trading versus options trading. We will compare them a parameter by parameter. The first one is the edge. So what is the edge in futures? There is no default edge in the futures. When you go long or short in the future, you are simply expecting the market to be in your favor. There is no edge in case of futures. But in case of option selling, there is a time decay, which is a default edge that you are getting. And the second one is hedge. So how can you hedge a future? There are less options. If you want to hedge a future with a future itself, then it becomes a arbitrage. But in case of options, there are plenty of choices that you have to hedge the option positions. Of course, the future can be hedged with options. Then that doesn't become a future trade itself. It's a combination of futures and options trading. The operational cost is quite high in case of futures. When I say operational cost, the STT, government charges, etc. are quite high because everything is calculated based on the value. For Nifty, it is around 9 lakhs. 50 into, let's say for example, 18,000 is a Nifty. So 9 lakhs is the value on which the government charges will be levied. But in case of option selling, it is on the premium. Premiums will not be 18,000, right? So that is why the statutory charges or the operational cost is quite low in case of options. Then coming to margins for futures is slightly higher and the margins for options is lower, and you can make it even lower by hedging and designing the strategies properly to reduce the margin. The MTM losses, the mark-to-market losses are paid or settled on daily basis to the trading account. But whereas in case of options, the margin only gets adjusted with the collateral that you have. When the MTM goes in the loss, you need more margin. That margin will get adjusted from the collateral that you have in your account, the margin money that you have in account. But whereas in case of futures, if you incur a MTM loss of let's say 10k, 20k, the 10k, 20k will be taken out from your account on daily basis. When you incur a profit, 10k or 20k will be added to your account. So that is in fact disadvantage. And long-term positions in case of futures, a maximum of 3 months is possible. As I told you, all futures are traded in monthly series only, and that too current month plus 2 months. But whereas in case of options, we have a long-term options that are possible, especially in case of Nifty and Bank Nifty, you can use them as well. The rollover charges, when you want to rollover is nothing but closing the position of the current expiry and moving it to the next expiry. When you want to do that, the operational cost will be high in case of futures, as I explained, and the operational cost for options will be lower, of course. Greed and fear. In case of futures and futures trading, the greed and fear is quite high because the profit is unlimited and the loss is also unlimited. So that is why the greed and fear is quite high in case of futures. But whereas in options, profits are always fixed, the credit or the premium that you have got. So the greed also is under control, and fear can be controlled by restricting the maximum loss that you can incur with the strategy. Futures are less flexible. You cannot design a number of strategies out of it. But whereas with options, there are plenty of options for you to design your strategies. So that is why if you are especially the beginner, do stick to options trading rather than the futures trading. Let us now discuss the trading in stock options versus trading in index options. In case of stock options, the liquidity is quite low compared to the index options, and hedging in the next month becomes very tedious, and also the long-term positions are not possible in case of stock options. Whereas in case of index options, very good liquidity, for example, Nifty, Bank Nifty and Fin Nifty, and long-term options, especially in Nifty, is available up to 3 years, and in Bank Nifty available up to 4 to 5 weeks. And sometimes some of the stocks can go out of the F&O band. If you are stuck in those positions, it will be difficult to come out. For example, S-Bank went out of the F&O band. Index options definitely will always be there. They are not going to go out of the F&O band. And the settlement for stock options is always physical settlement. If you have opted for the physical settlement, you have to be having 1 lot equivalent of shares or cash to deliver or take the stocks. And in case of index options, they are always cash settled. There is no headache of physical settlement at all. Of course, if you are doing the monthly income strategies with stock options, for example, covered calls or option wheel strategies, having stocks or equivalent amount, physical settlement will not be a problem, but you will have to know the proper selection of the stocks. Friends, initially I would recommend you to stick to index options and then slowly try stock options trading. Here is how you can maximize your returns from the investment or trading is that, first of all, invest your money in any of the assets that can be pledged. So those assets can be stocks, mutual funds. Mutual funds include equity mutual funds as well as the debt mutual funds. And you can also invest in the bonds that can be pledged. Once you pledge these assets, you can use the collateral feature that is given by your broker and get the margin that will be given to you after the haircut. So the haircut is nothing but a safety margin that exchange takes, which varies from 10 to 20%. So after removing that haircut, you will get a margin money to trade in any of the futures and options. You can use that margin money to trade in the options. So this is how you can make your money work hard by reusing the investment. And do not ever leave large amount of your money in your trading account. Always invest in any of the assets. If you are not comfortable with the stocks or equity mutual funds, at least you can go for keeping that money in the debt instruments such as liquid Bs, which are nothing but fixed deposit kind of instruments, giving you a return equal to the bank fixed deposit. And you can always sell those liquid Bs anytime. The money will get credited back to your trading account. So by this way, you can generate 4 types of returns. First one is the yield from your assets itself, that is pledged. For example, it could be stocks or liquid Bs, etc. That will give you some return, and you will start generating the return from the option selling. So that is a second return. And from the hedging also you can generate a return as well. So this is how, if you can manage your money well, you can maximize your returns from the capital that you have. Here is the table explaining the different assets or the instruments and the respective yearly return. This is a yearly return, not the monthly return. So the first one is a debt instruments. The debt instruments can be liquid mutual funds or liquid ETF funds such as liquid Bs. They give you a similar return as the bank fixed deposit, which is around 4 to 6% depending on the duration that you invest. Of course, you need money to get this return from this type of instruments. Next one is the equity instruments. Equity instruments can be stocks or equity mutual funds. It can also be Nifty and Bank Nifty Bs. So these are nothing but the equivalent value of the Nifty and Bank Nifty indices. You can buy them like any other instruments and stay invested. Of course, the return from these equity funds is as per the market returns, and you need to have the money to invest these in these instruments. Next comes is the option selling strategies. You can do the positional option selling strategies such as ratios, triangles, straddles, etc. and generate a yearly return of 10 to 15% of the margin that you utilize for trading in these strategies. And the margin can come from the above two instruments. One is a debt instrument and equity instruments. You don't need an additional money to trade in the option selling strategies to make this return. You can also do option selling intraday if you are an expert. For example, expiry trading, Wednesday trading, etc. to generate 2 to 4% return yearly. Again, this can be using the margin that is taken from the first two instruments, that is debt and equity instruments. So overall, all put together from all the four instruments, one can achieve 12 to 20% of yearly return, which is a very good return. If you can do well, you can go up to 12 to 20% per annum as a collective return, which is a very good return in my opinion. Friends, some of the people are not fully aware of how to interpret the payoff graphs. So I am going to give a quick introduction of how to interpret the payoff graph and also few examples. You don't have to sit and draw these payoff graphs. If you are using the option trading tools, the payoff graphs will be automatically generated, which will show you the various parameters like break-even points, max profit, max loss, etc. So here is the basic principle of the payoff graph, how it works. The vertical line is the profit and loss line. 0 is the point where there is no profit and loss. The more you go down, more is the loss. The more you go up, more is the profit. The horizontal line is the asset or the stock price movement line. And this vertical dotted line is the strike price at which the option is being executed. So from this strike price, if you go left, that is the decreasing value of the stock or the instrument. Right side, if you go, it is the increasing value of the stock or the instrument. Let us now look at few examples to understand the complete payoff graph. Here are two payoff graphs. One is the long call option payoff graph and the short call option payoff graph. For the long call option payoff graph, let us assume that the strike price is here and you have paid this much of premium, which is the maximum loss. So that is why it is showing you the maximum loss is this much only. And in the long call option, what is that you are expecting? The market or the instrument to go up so that you can make a money. Since you have paid this much of premium, the break-even point comes here. Break-even comes here. So you will not make any money till the market or the instruments go beyond this break-even point. If the market goes or starts going up from this break-even point, you will continue to make an unlimited profit in case of long call option. So this is how the long call option payoff graph works. Coming to short call option, you have sold a call option, you are expecting the market to stay below that strike price. And the maximum profit is the premium that you have collected. See here, the maximum profit is fixed, which is equal to the premium received. And the break-even point, what happens? The call option plus the premium that you have received. So this becomes the break-even point. And if market starts going up beyond this break-even point, you will continue to lose the money, which is unlimited loss on the upper side. So this is the short call option payoff graph. Coming to the long put option payoff graph, let us assume that you have gone long in the put option at this strike price. So what are you expecting? You are expecting the market or the instrument to go down so that you can make a money. So what is a max loss here? Again, the premium that you have paid. So this is the maximum loss. And the break-even point again here is the strike price minus the premium that you have paid. Here is a break-even point. And if the market starts going down, you will start making unlimited profit. So this is the long put option payoff graph. The short put option payoff graph is opposite of the long put option. Let us assume you have sold a put option at this strike price. So what are you expecting? You are expecting the market to stay above the strike price to make the money. The maximum profit is again fixed, the premium that you have received, and the break-even point is strike price minus the premium that you have received is the break-even point. If the market starts going down beyond this break-even point, you will start making unlimited loss in the sold put option.